For financial advisors that work in the competitive market of small business owners, understanding the changes to the tax code will differentiate you from the competition. On this episode, certified public accountant Shelly Bykat joins me to discuss the most important changes that you need to know.
This is the Resilient Advisor Podcast, the show for high-performing financial advisors. We bring you the best practices of the industry's top performers so that you can build resilience in your business and your personal life.
Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter. In my experience coaching top-performing financial advisors, the professionals who are at the top of their game and are focused on adding value to their niche by staying on top of industry changes. If they serve small business owners, there have been a lot of changes in the tax code that you need to be up to speed on. Shelly Bykat is joining me today. She's a certified public accountant who has spent her whole career focused on serving small business owners. She has graciously agreed to come on the podcast and share with you how her clients, the small business owner, are being impacted by these changes. Shelly, thanks so much for coming on the podcast.
Thank you so much for having me. I'm very excited to be here today.
I got to tell you, Shelly, this is a topic that is so far outside of my wheelhouse. I hope it'll be okay if you let me ask you some uninformed and potentially downright ignorant follow-up questions.
Absolutely. I love it. I love to answer questions for clients.
Yeah. Well, I love your passion about taxes, so that's why I knew you'd be a great guest for this episode. You sent over a list of items that you think advisors who focus on small business owners should be paying attention to. Why don't I just run down the list and you can put some color on it? Would that work?
All right. Yeah, that sounds great.
All right. Why don't we start with depreciation? And specifically, let's talk about how small business owners need to think about vehicle depreciation.
Well, the vehicle depreciation rules, while they have been great in the past, they're even better this year. They have taken the bonus depreciation rules and changed it. So instead of only being able to deduct 50%, you can now deduct 100% up to the business use portion, of course. But it's also limited. You also can buy a used vehicle. It used to be that you could only buy new assets under the bonus depreciation rules. But now you can buy a used vehicle with a greater than 6,000 pounds and be able to write it off 100% in the first year up to the business use percentage.
Okay, so what if you bought a vehicle last year? Do you have to continue under the old rules?
Yes. This only applies to the 2018 tax year.
To this year, okay. So, all right, so the big change there for the small business owners, they can get into the used vehicle market and get that nice deduction if it's over 6,000 pounds, whereas before it was just new. Okay.
Correct. Well, the bonus depreciation rules, they were able to take depreciation under what's called Section 179, but this is a better write-off overall. It's going to be a better write-off. So that's why you would be geared towards doing the bonus depreciation rules.
So that seems like a layup talking point for a financial advisor in one of their early interactions in 2018 to say, hey, just want to make sure you knew that you can now use used vehicles and get this bonus depreciation.
Absolutely, because clients call all the time and say, hey, I was thinking about changing my vehicle in. Is there anything I need to know before I go buy a vehicle? Mm-hmm. Well, now you can say you don't have to buy new. You can go buy a used vehicle and you can write it all off as long as you're using it for business.
Perfect. Let's move on to building improvements and depreciation. What are the new rules?
Well, the new rules are that if you are doing leasehold improvements in your business inside of a non-residential building, you can now write those off. Roofs, heating and AC, security systems, these things, as a business owner, you have to make these improvements within your building. And now you can write those off fully in the first year. It used to be that it took years to write those off. So you had to lay out the cash up front, but you couldn't deduct it right away. Well, now you get to deduct it right away. So that's a pretty exciting thing because those usually are not small expenses.
So for the financial advisor, again, in these early conversations in 2018, the talking point is, hey, Mrs. Business Owner, we talked about A, B, and C in the past. Just want to make sure you knew that those improvements you've been holding off on, it's much more impactful to get them done this year. Make sure you talk to your CPA about that. Did I say that correctly?
Absolutely. I would encourage that. Yes, I would encourage that for sure. And just keep in mind that this does not apply to residential rental. This only applies to non-residential. So that's an important point.
Gotcha. So the client that has a small business but also the residential properties needs to make sure that they're aware of the difference.
Right. Because that's big. It does not apply to rental properties, only commercial.
Okay. Let's move on to entertainment and the changes in the code and how it affects small business owners that have entertaining as part of their business.
Yeah, this isn't a win for the businesses. They are no longer allowed to deduct the entertainment expense. So if you're buying tickets to the symphony and giving them away to clients, you cannot deduct that anymore.
Yeah,
so
that's
and
big
the meals
for certain
are
industries,
still
right?
allowed. Yeah, it is big. It's big in the big corporations. And the small businesses, you don't see it quite as much because they don't have as much cash flow to spend on these things. So I think it's going to affect a lot larger businesses more than it will small businesses. But it is important to note that meals are still deductible at 50%. I think a lot of people have gotten confused by that, but they are still deductible at 50%.
Okay, can put some color on that for the financial advisor who, like about half of our audience are the independent advisor that are LLCs or S Corps. What do they get to expense specifically? Let me give you two examples. You go and you take a client out to dinner and their spouse. Are you deducting 50% of that?
Yes, as long as you're talking about business, you are.
Okay. And then if you are on the road and say you're based in Atlanta, you travel up to Nashville, and you have client meetings all day, and then you go out to dinner, and it's just you.
Yes.
Is that meal 100%?
Yes, because that's business travel. You're traveling related to business, so that meal is deductible up to 50%.
Gotcha. Okay, but then if you have a client at that meal outside the road, obviously there's the 50% again. Wait, I'm sorry, Shelly.
Yeah.
This is why I'm so ignorant on this. Let me be crystal clear.
Okay.
The business owner's on the road, has meal by himself.
Yes.
He's only deducting half that meal.
He's deducting. He's taking 50%. Correct. If he's by himself or if he takes the client out, it's still 50% deductible.
Gotcha.
Because it's a business trip. He went there for business. He can deduct the cost of the hotel. He can deduct the meal. The hotel is 100% deductible. The meal is subject to 50%.
Gotcha.
And I do think clients get confused by that, especially when it comes to travel. They think that because it's travel, the meal is fully deductible. It is not. It is still subject to the 50% limitation. If it is a meal and it is business related, then it is subject to the 50% deductibility.
Gotcha. Thank you. That's crystal clear now. Let's move on to moving expenses for employees. So the small business owner that is recruiting folks, they've compensated folks for moving expenses. That's gone, isn't it?
Yeah, well, they would have, correct, it is gone. It hurts the employee, especially if you want to move an employee. It hurts the business because you can no longer move the employee from one location to another and then not be able to deduct the moving expenses. It would have to be included. If you're going to pay for that, it would have to be included in their W-2s. So it is, but I probably for small business owners, it's not as big of a deal, but it is, it does affect people. So
yeah,
it's something to be aware of.
And there's an exception for that?
Yes, there is. Armed forces are the exception.
Okay. Now, you mean active armed forces moving or people who have been in the armed forces?
I do believe it is active, but I would have to check on that.
Okay, so the small business owner that hires somebody that is also in the military, they can then deduct those expenses if they move them?
I would believe that would be the case.
Okay, awesome. All right, let's move on. Next item on your list, Employee Achievement Awards. Tell us about that.
Well, the Employee Achievement Awards rule changed because now they are requiring that whatever is provided to the employee is tangible personal property. But just because you can touch cash or gift cards doesn't mean you can deduct it. Where I see this a lot is around Thanksgiving time, and employers give honey baked ham gift cards to their employees to go buy their Thanksgiving dinner. They need to be aware now that you cannot do that. You have to actually buy the meal for the employee.
Shelly, why do you think they put that rule in place? That seems asinine.
I think a lot of things they do are asinine, Jay. I think the reason that they did that is I do believe there probably is a lot of abuse out there with these gift cards, because I think gift cards are used a lot, and I do see them a lot on people's books. And I think that it was probably being people were taking advantage of the tax law. So I think they're just trying to hone things in a little bit. That's my impression.
Okay. And how do vacations fit into this?
Well, it's just important to note that you can't just send an employee on a vacation. You can't be not include it in their income, or go buy them a meal and not include it in their income. You have to give them something. The awards have to be tangible things that they can touch. So you can't give them tickets to events like we talked about before. Those are no longer even deductible. But you remember how lots of companies will buy tickets to the Falcons game and then they'll just give them away to the employees? You can't do that anymore. So you just have to be aware of what you're giving your employees.
So specifically, if they were to give those tickets away to an employee, do they have to put the cost of those tickets into their W-2?
Yes, they would have to. That would have to be included in their income.
That's crazy.
It is crazy. It is crazy, and it's hard to track. It's really hard to track because you got to make sure you call it into the payroll company and make sure that you're tracking everything. So it's probably just better not to do it, quite frankly, than it is to fool around with it so much.
I would think to a small business owner that isn't working closely with the CPA, they're probably not aware of that. So for a financial advisor that is in that marketplace, that's a great talking point just to make sure they're aware of it.
Oh, it is. It's so good when financial advisors can give the clients advice that when they're talking with the clients, because they probably talk to them on a different level than the CPAs do. And I do think it's great when they can give them advice, and then we can come on the back end and say, oh, yeah, that's correct, that you're exactly right on that. It facilitates the conversation is what it does.
Okay. Yeah. Excellent. Excellent advice. All right. Let's talk about qualified business income, the new deduction. Shelly, give us an education. QBI 101.
QBI 101. First of all, even though it's called QBI deduction, it stands for Qualified Business Income. So it's kind of an odd title, but it is a great, great opportunity for our clients. The purpose of the deduction was to help business owners pay the same tax rates as the new deduction for C corporations, which is 21%, even for personal surface corps. That's the purpose of this deduction.
Okay. Could you go a little deeper on maybe the execution on that?
Sure. So the deduction is for businesses. So that means that if you're a W-2 employee, you do not qualify for this deduction. It is the income that you earn from your business, whether it's a Schedule C or a flow-through entity. You get to basically take that income and multiply it times a percentage and get to deduct that amount potentially.
Okay. So let's just go through a hypothetical example. Small business owner doing $500,000. Well, let's make it even easier. $100,000 in revenue.
Okay.
Walk me through how they would go through reporting that, just high level, so the advisors listening could speak intelligently about this with their small business owners.
Okay. So if you're a small business owner, and let's say that you do not have taxable income of greater than $315,000, then you will be able to potentially take $100,000 times 20% and deduct $20,000 against your ordinary income.
Gotcha. Simple enough, actually.
Yeah. It's simple enough in the calculations. There are a lot of different caveats, but that's the basic calculation. It's also that way if you have a flow-through, With an S corp, the income that comes in, if that's $100,000, again, you get to take that 20% and multiply it times that income that comes in, and you get to deduct that amount potentially. There are other hoops you have to jump through, but that's the big picture of it.
Excellent. So I want to talk about some of those hoops, but before we do, for the financial advisor that wants to initiate that conversation with the small business owner, just to make sure that the business owner client is in tune with their CPA, what language could the advisor say to the small business owner? How would they make sure that they were in tune with this new QBI?
So the couple things that they need to think about are what type of business are they running, because the deduction is based on the type of business. Everybody gets the deduction up to a certain point. So they just need to understand that it's any income, business-oriented income, that they are generating. They get to take that deduction on their individual income tax return. It's not at the business level. So they need to encourage their clients to be talking with their CPAs to look at, hey, does my business qualify? And if it doesn't, what are some things that we can do to get my income down so it does qualify? Also, you want to look at it from a perspective of if you are going to have qualified business income and there's an opportunity to make that number, the qualified income, actually go up, the deduction itself goes up. And does it make sense to actually not deduct something or take depreciation right off in the first year in order to have a higher qualified business income deduction versus taking depreciation in the first year? And then if you decide to not take depreciation in the first year, you can write it off over the next years and you get the benefit of both. So there's some definite planning opportunities there.
So then at a high level, the question that a financial advisor could ask the small business owner is, hey, have you connected with your CPA yet on whether you're going to qualify and what potential changes you need to make for this new QBI deduction? Just an open-ended question.
Absolutely.
Like that. And now they have enough information to speak intelligently about it. And as any advisor listening knows, bringing this to the attention of the small business owner early in 2018 differentiates you from your competition because, A, not only are most of them not doing that, their CPA probably has not reached out to them yet. So that's fantastic
Probably
advice,
not.
Shelly. Let's take a minute and go deeper for some of the wonkier listeners of this podcast who want to know a little bit about the hoops you have to jump through. Tell us what we need to know.
Well, so first of all, it depends on what type of business you are. If you are a service-oriented business, meaning the income in your business is derived by your skill set, by your mind, CPAs, for example, lawyers, doctors, then you only get the deduction up until $415,000. It stops after that. That's a big deal.
Okay.
So if you have a client and you're unsure of whether they're a service-oriented business or not a service-oriented business, that's the first thing you actually need to be looking at.
Makes sense.
Because if you are a service-oriented business, you want to try to get their income at least below $415,000, and if you can, in between that $300,000 and $415,000 mark, because it phases out.
Okay.
For the non-service-oriented business, you do get the deduction no matter what. However, it is limited once you hit that $415,000 mark. So the taxable income limit is very important, and it's important. And I'm talking married, filing jointly. I am not talking single taxpayers here. So that's important to note. It's cut in half for single taxpayers.
Okay.
So the spread for married is $100,000, and the spread for single taxpayers is $50,000. So once you start to get up there in that higher income limit, the amount you get to deduct of that 20% goes down. And it is at the individual income tax level, as we discussed earlier. So if you have multiple businesses flowing into your individual income tax return, you have to take all of that into account because, again, that flows through to your individual return, which comes to your taxable income, which is a partial limit. There also is a wage limit, and the wage limit at the company level, so if you're an S Corp or a partnership and your income flows through to you, and you're above $315,000, you can only take 50% of the W-2 wages that are allocated to you, or the 20% of the QBI.
Gotcha. It's an either or proposition.
Correct, whichever is less.
Whichever is less. Okay.
Yes. So it's complicated, and there's another limit. It's the W-2 limit, and the percentage of the property the business owns. I'm assuming for our discussion purposes that the business doesn't own that much property, and they do have wages they are paying to clients.
Okay, gotcha.
It's complicated. There's a lot going on. The key for the advisor is to understand that this is out there and just start learning that, oh, wow, this taxpayer might have the opportunity to take 20% of their income from this business and deduct it from their income taxes.
Yeah, that's right. So
that's what's important for the advisor.
Yeah, Shelly, these are fantastic talking points for the advisors that work in the small business community. I appreciate you coming on to talk about it. Tell me, is there anything else before we wrap up that you think the financial advisors need to know about the new tax law changes?
Well, I think it's important to note that this really is going to be a big win for taxpayers, owners of small businesses who can now use their cash in their business versus paying it to the IRS. It is really a great opportunity for our clients, and it's our opportunity to get in front of them and explain to them the new rules so we can look like we really understand what the new rules are and how it's going to benefit them. It's very, very exciting.
Fantastic, Shelly. Shelly, how can listeners get a hold of you?
You can reach me on my phone at 404-210-0577, or you can email me at sbykat@stressor, STRESSERCPA.com.
Excellent. I'll have all that information in the show notes as well. Financial advisors, I encourage you to follow Shelly on LinkedIn. She's putting some content out there that will really help you elevate your conversations with your small business owner clients. Shelly, thanks so much for coming on the podcast.